Tough talk on inflation. That's our topic for today's Backstage Pass. Well, hey there. Hope you're having a great day so far on this wonderful Thursday. Mortgage bonds and stocks are both lower today. That means mortgage rates are going to open up about where they closed off yesterday, but we could be getting into some negative reprice territory on the day. We'll talk more about that in just a minute, but first let's talk about tough talk on inflation. So Fed Chair Jerome Powell was on CNBC earlier today, and he was discussing how he and the Fed are committed to doing whatever it takes, committed to combating inflation and bringing inflation down. He said that inflation is still too high, and they're committed to doing whatever it takes to reduce inflation. Well, their counterparts over in Europe at the European Central Bank, they actually raised their equivalent of the Fed fund rate, their overnight rate, by 75 basis points and brought it into positive territory for the first time in a long time. And the ECB president, Lagarde, had a lot of tough talk on inflation as well, but Lagarde continued to discuss and talk about how there's a continued risk for higher inflation in the European zone in the future. And so even though there was some tough talk on inflation and how they're going to continue to combat it as well, his discussions and his comments on the continued risk for higher inflation over there, that actually got the bond market spooked in the European zone. The 10-year German bond, the yields went up. That actually put some pressure on U.S. yields this morning in the morning trading session and then throughout the day today. We'll talk a little bit more about that in just a second. But the other news of the day was jobless claims. So initial jobless claims came out for last week. This showed that initial jobless claims decreased by 6,000. These are people that are filing for unemployment benefits for the first time. Continuing claims increased by about 36,000. So the initial jobless claims, well, that's the lowest it's been since May. Continuing claims, well, that's the highest it's been since April. And what this shows us is this is showing us that layoffs or jobless claims is decreasing right now, but continued claims, well, that's going up. So the people that have already claimed unemployment and started that initial claim, well, they're continuing and they're staying laid off. They're not going back to work right now. And the employers that are laying off employees, well, that's slowing down. Now, why is a good question, and it probably has something to do with the fact that whenever you lay off an employee, it's much more difficult to hire that employee back or replace that employee, including training and all the stuff it takes to get a new employee up and running. So it really shows us that employers are kind of holding on to employees longer, hoping that they don't have to do layoffs in order to make sure that they don't have to refill any positions later on down the road. Now, with what the Fed is doing, the expectation is to start to see that initial jobless claim number start to go up. And we're not seeing that quite yet. And we think that's really what's going on, is employers are reluctant to lay off employees because it's very difficult to replace an employee, hire them back, or replace them with another person in the future. So that's kind of what's going on in the jobless market. Or the jobs market. But moving back to the bond market, and the big surprise today, again, is all the tough talk that's coming out of the Fed and out of the European Central Bank. We would expect the mortgage bond and the bond market to respond positively, but it hasn't. And again, it goes back to the fact that despite all the tough talk, there's still some talk about, especially out of Lagarde, that there's risk of higher inflation in the European zone in the future. And again, that put pressure on the German bond. The yield of the German bond has gone up, and that has in turn spilled over here to domestically to the United States. 10-year yield is up about 3 basis points, 4 basis points, somewhere around there at the time of recording. Mortgage bonds are down about 19 basis points. And again, mortgage rates, they opened up about where they closed off yesterday. The national average for a 30-year fixed was 6.12% yesterday. Mortgage rates opened up at about the same spot, but throughout the day, the continued pressure from the European zone back over here to domestically, well, that could be bringing us into negative reprice territory. So we're expecting the 30-year average to come in again around 6.1%, maybe 6.2% today. That's the expectation. We'll just keep an eye on it and see. Now, that's all the news that we have for today. I hope you have a great day. Remember to like, comment, and subscribe. If you have any questions, be sure to leave a comment with your questions. And don't forget, stay positive. Have a great day. We'll see you tomorrow.